All right, we're back. Going live, Eric.
Happy New Year.
Happy New Year. I don't know how many people will be watching this live. We'll probably put the replay up on our YouTube channel. But for all of you who don't know what's going on and don't know why, you haven't seen. I'll tell you what, Eric. The last time we did this was June of last year.
No way.
Does it feel that long?
No, it feels like we were just doing this a month ago.
Right? It's been a while. So this is our Casual Friday broadcast, podcast,
even though we're both dressed up.
Webcast. Yeah, right. And so if you haven't watched this before, this is where Eric and I, or if Eric's not around, other advisors in the office, go through a few charts that caught our eye during the week, where we can talk a little bit about markets, talk casually about markets. We're not going to get into too much nitty gritty. We're not getting into
any vectors or logarithmic trading functions.
Yes, we are getting into strictly. Let me see if I can change my microphone.
See, we're getting back into the swing of things. We are not getting into too much nitty gritty, not too much jargon. We're just getting down to brass tacks. I think we can start by just recognizing that this week, the first week of January, the first trading week of 2022, was bad. Stocks were down, bonds were down. Eric, you want to take a stab at which of the indices was the worst this week?
NASDAQ.
Winner, chicken dinner. You want to take a guess at how much it was down, or do you know this number already?
I do not know this number, but I don't know. 4%.
Nice. A little bit more than 4.25, 4.28%. S&P was down 1.7. Dow was almost flat, down just a little bit more than 0.1%.
That makes sense.
International and developed markets were actually up slightly this week, interestingly.
It's about time.
But here you go. Here's another one. The Bloomberg Barclays Ag down this week. You want to take a stab at this one?
2%.
1.25. A little bit more than 1.25. So not great.
It was the worst week for the S&P since 2016. I just read
Yeah. We've had an auspicious start to this week, to this year, which is interesting. I'm sure next week we're going to have a whole bunch of charts saying if this week was bad, then how does it mean for the other?
This will be the best year for returns if this is the worst second week of January.
I feel like last year we had a good first week, and that meant we were going to have a good year. I know there are always those indicators. It's like, oh, the first 2 trading days. Technically, we had a Santa Claus rally, right? Because Monday was a good day. Interest rates are rising. That's one of the things causing some of this problem here.
The volatility, we saw it coming. I mean, every time there's a headline, everyone's looking for the perfect number on everything, and any surprise, you see the reaction.
Yeah, I guess the surprise this week was the FOMC minutes, right?
Yeah. Which I find it funny it takes so long for them to release those.
I know, but if you'd asked anybody, do you think interest rates and inflation are going to be a thing this year? Everybody would answer yes. So how we're getting caught flat-footed, or investors are getting caught flat-footed with rising rates, is silly. But I think it was the minutes showing that the Fed was really going to be
looking
aggressive
to reduce the balance sheet. I mean, you got to remember too, those meetings, these are just guys talking like us. It's not policy. So
they call it casual FOMC meeting.
Exactly. It's the last one of the year. What do you guys want to talk about?
Yeah. Hey, well, what they can do is what we did today and order some ridiculously spicy chicken.
Yeah, I'm still sweating.
And speaking of Casual Fridays, if I don't see why anybody would know this, but on the first Friday of the month, Jobs Day, right? We order food in for the office. This week it was Eric's pick, and what is it? Angry chicken?
No,
spicy chicken? What's it called?
Spicy Birds.
Spicy Birds.
Spicy Birds. That's the good one.
That's the good one.
Yeah.
And I can vouch it was hot. Like hot. I got one level under nuclear and I was sweating.
I've had it before and I know what my limit is. And I got a medium just because I didn't want to, starts sweating profusely.
Yeah.
I think they mixed up my jar because it was spicy.
Nice. Well, hey, that's why we got it, right? Well, it was good chicken. I don't know that I'm going to go back soon, but it was good. It was good. Well, and we, I'll before we get into the charts, we're talking about the first Friday of the month. Today was the jobs report, right? Maybe we can get into this a little bit more deeply next week or the next time we do this, which will be sooner than 6 months from now. But unemployment down, but the jobs report disappointed by a lot.
Yeah, it was a low number. But
I mean, that was even low for people who were guessing low.
Yeah, I mean, it's the mid range was a lot, but was 200,000? Is that what the number was?
Yeah, just short of 200,000 was the number. I think the expectations were closer north of 400.
4 to 5. But I think it's very possible that number gets revised. I mean,
sure,
that happens a lot when there's such a disparity between the unemployment rate and the job ads.
Yeah, well, and you get with all the COVID stuff also. I don't think there's been an accurate number in the last 12 months. Yeah. That hasn't been like really, really revised. But the unemployment number went down
under 4.
Under 4. I mean,
that's full employment.
That's pre-COVID levels almost, if not exactly. If you're not at full employment at 3.8 or 3.9%, when are you? When is an economy at full employment? So, well, cool. Well, let's jump in to our first chart here, and we can get into talking about volatility right now that we're getting this week and first of the year. Let's start by checking out the last year's volatility. So here we go. First chart of 2022 is a chart looking at 2021. Right. So this is something I posted this on LinkedIn actually this week because it kind of struck me. This shows 5% pullbacks in a calendar year for the S&P 500. The orange line is, I chose this one. The next one is going to be Eric. So this is why I'm rolling with this. So it shows the orange line there. You can see in orange print, we average nearly 5% pullbacks in a year. And last year we had one. And that one was in September, actually, during the Evergrande.
Was that really 5%? I thought it was like 4. I guess it's on the chart. It must be real.
Yeah. 5.2, I think, was the actual number from the peak to trough. But still, that's
surprising.
Well, look at the year before. 2019 we only had 2, but especially it seems some of these years that are pulling down the average were those years in the 50s and 60s.
Yeah,
right, because you look at 2000s and the 2010s, we get many more spikes there.
I mean, if you look at this chart, and I don't know about you, but I know I was waiting for way more last year than what actually materialized.
Yeah, I think that just goes to show the amount of stimulus and what exactly was being kind of dumped, the support that the economy was getting, right? Because this is the year we're going to have to, the economy's going to have
training wheels off.
Training wheels, yeah. And so, here you go, lots of stimulus, artificially low interest rates, Fed buying bonds. I mean, rates were low. Everybody was risk on, not much volatility. It doesn't surprise me also that the one bout of 5% volatility came late in the year, right? Where all this is kind of starting to peter out a little bit. And I think the other thing it tells us is even if we get back, well, there's no such thing as average. You can count on here the number of times we actually hit 3. We're either above or below,
there.
Right?
Yeah.
And so even if we revert to average, it's going to feel like we're getting killed. Not shown here is the fact that we have a 10% or more drop at least once a year, or on average once a year. And we didn't get one of those last year.
It shows you that trying to time this stuff is, I don't want to say it's futile, but
it is.
If you wait for a 5% drop and you're missing a 15% run, you're going to miss it.
Yeah. In fact, I think one of the charts that we've done in the past was showing that, if you miss the 5 best days of the year, which often come after the 5 worst,
Yeah.
You submarine
on-
your returns by like half in the calendar year. So,
yeah.
So that's it's an interesting look back, and I think it's fair to say that we're going to see some volatility here this year. Hell, we've already seen it. We're already seeing it right now.
Yeah.
The kind of volatility.
Had more volatility this week than all last year.
Exactly. Almost all last year. Let me get in here with your next chart. I hate fiddling around with this, but this is
you're doing a great job.
Yeah, thanks. All right. So now we're going on. We're leaving last year in the dust, mercifully. And we're looking at your chart right now, which is all-time highs on day one. You want to walk us through this one?
Yeah, I mean, one, it's you have to take these kind of charts with a grain of salt, right? I mean, it's one day for a whole year.
Yeah.
And
there's only been 5 of them.
Yeah, that's what I thought was. I mean, I guess that is rare out of 65 years or so, just 5 times. But and you don't want to mix up, correlation with causation or anything like that.
Sure.
But I mean, if you look at these, one day gains, if you're a betting man, it looks like you're in for a good year. I mean, 80% of the time.
Yeah, I'll be honest with you. This one feels like the sample size is so small.
It's like data science. You can find any correlation
I think
you want.
If we can maybe chalk this one up as like interesting, but nothing to base your investment strategy on, right?
Unlike our last slide.
Yeah, well, yeah. I mean, I think the last slide, at least it gives you. I think the last slide gives you a little bit of context about how serene last year was. Like if you thought last year was bumpy, you really need to kind of examine what your tolerance for risk is. Here, it's interesting. I think it's also interesting that of the 6 on this list,
half of them are in the last 4 years.
Yeah, exactly right. In 2018, the full year was down 6% for the S&P. That's because rates were going up in October, November, December, and Powell said that we were on autopilot, if you remember.
Yeah.
And then we went on 60 Minutes and promptly took his foot out of his mouth the first week of January. 2020 had a big gain headed in. That was kind of the runoff from a hell of a 2019. But January was bad as COVID was starting to flare, and then you had a full year of government stimulus.
And we know how that ended.
Yeah, so this is like even all these years are kind of manipulated. Policy mistake in 2018, you could argue. 2020 was totally
these aren't normal years, so if there is such a thing, right?
Yeah, I think there's your takeaway, right? Like, stop expecting normal years. Stop expecting 5% 3 times a year. 5% drop 3 times a year. So, well, this is a good one. Well, we'll see. I don't know. We're behind the 8 ball here in January. There's some makeup to be done right here in the January number, and then God only knows for the full year here.
We'll see what this chart looks like in 2023.
Yeah, right. Yeah, stay tuned. We'll check back, right? All right. So let's get out of this one here. If I can exit out of here. 2 more left. This one. So the last we were looking at. Let me get full size here. So we looked at last year. We looked at the start of this year. Now let's go forward here. This is the one that I chose for this next one. As we go forward, we're in year 2 of the presidential cycle. And this shows that generally year 2 of the presidential cycle is the weakest. It doesn't surprise me here. So I'll walk through it a little bit. Year 2 on average is up 6%, and on average is up 55.5% of the time, which is lower than all 3 years in each way, both as how much it's up and how often it's up in that year. I can't say this is too terribly surprising, right? Because what it's also showing are election years, right? The second year and the 4th year, you're barreling towards an election. And in this case, the midterm election. I don't know. Do we need to worry about the election, Eric?
I don't think so. Like you're going to see, I guess, lackluster performance compared to other years. But I mean, for the most part, elections don't seem to impact returns. If you look at all years.
Right.
So, I mean, I'm not too worried about the election.
Yeah. Well, it's still positive more than half the time.
Yeah.
It doesn't inspire a whole lot of confidence when you have an entire congressional body running around telling you how bad it is and that they're the only ones who can fix it. It's interesting also, I think if you look, maybe we can do this next week. If you look on the calendar year, how in election years, things kind of surge and wane. They're usually when you get your returns in an election year, it's usually in the last couple months of the year. That's especially true of a presidential election year. And so I don't know.
It's presidential years are actually, I think, better than the average years.
Yeah. Well, you can see year 4 of a presidential cycle here up 83.3% of the time, versus the first 2 years are up the least often, I guess is the way of putting it. It's the percentage of time higher is lower. So anyway, I think the takeaway because this is a little bit of a confusing chart because you have the percentage higher here on the left side and the percentage of time it's higher on the right side.
Yeah, I had to have you explain this chart to me before we got. I was like, what is looking at?
But either way, year 2 is the weakest. Doesn't mean it's bad. It just means it's the weakest. Oh, I forgot to change our little banner. There we go. Year 2 of the presidential cycle. Year 2 is the weakest. So we'll see how this year shapes up. Again, the danger of statistics and averages and
it seems to be just get fewer and fewer normal years, whatever those are. So you have to look at the charts.
Yeah, I don't even know. I used to wish for a normal year. Now I don't even know
what you're wishing for.
Yeah, what on earth it's about. So take a look here. We're going with the last one now. We're doing football. We're going max statistic predictive. You pick this one. Why don't you walk us through it?
So first, I wanted to add a little bit of color to it, and that if you actually included when Tom Brady won the Super Bowl with the Buccaneers, that increases his winning average to 9% return. Okay. So what we're looking at here is years that Tom Brady's in the Super Bowl, which happens a lot. And what happens when he wins and when he loses. So when he wins, it's good. So we do have to agree with LPL research that we don't advocate any kind of investment strategy based on the winner or loser of the Super Bowl.
Sure.
So just get that out of the way. But if it's pretty persuasive. I mean, if he loses, the market's down 10%, and if he wins, it's up 9%. So if I were a betting man, and not to mention the fact that he wins 70% of the time. So if I were a betting man and Tom Brady's in the Super Bowl, I would bet on him, and I would bet on the market too for that year.
Well, he wins more often than not.
Yeah.
And markets go up more often than not in a calendar year.
Are you trying to say that Tom Brady has nothing to do with S&P returns?
No, not at all. Because that guy's a wizard. He is. Every time you think he's out, he's in. Just ask the Jets, right? And so it is most certainly causal, right, with Tom Brady. But I think, don't bet against either. Maybe is the takeaway from this. I guess.
Yeah, I'll take that.
This is a good one. As I know we don't do a whole lot of sports stuff here, and that's by design because not everybody's into that stuff. But this is a good one as we get into January. January used to be Super Bowl time. Now Super Bowl's in February, which is a travesty.
Now they have the US. I saw a commercial for the USFL. Have you seen that?
Yeah.
Now we have spring ball.
I mean, everybody's just dying for content. They need stuff to sell, right?
That's seriously.
That's all there is to it. So
who do you like for the Super Bowl?
Who do I like for the Super Bowl? I don't know. I'm gonna go so far as to say I don't care. Not because I don't like football. I do. I'm just hoping that my Niners get in there somehow, get into the playoffs. I'm in the middle of trying to brainwash my kids into being 49er fans. I need some help from the 49ers to make that happen.
Yeah.
How about you?
So I should don't open that package. I just sent your kids a Patriots football.
Oh,
don't open that.
No, I'll give that to the dog. So you're a Patriots fan?
Yeah, from Boston. So
yep. So that makes sense. So Bruins, Celtics,
Sox.
Patriots. Yep.
Red Sox.
Well, good. Well, there you go. Titletown. You guys went from tortured to spoiled. Congratulations.
Yeah, it's hard to be spoiled. I mean, I used to not watch the Super Bowl if the Patriots weren't in it.
Well, that was a long time for a while.
Yeah.
And now you're spoiled right. Well, you've got the second coming with Tom Brady, so congratulations on that as well. You know. Well, good. Well, I think we'll leave it there. Eric, happy Friday. We made it through the first week of 52, just 51 more to go. I'm not going to bother Googling how many days until Christmas, but it'll be here before we know it. So anyway,
hopefully the supply chain is worked out so we can order our presents a little later in the year.
God willing. Yeah. Supply chain and everything else for that matter. So, well, good. All right. Have a good weekend, and let's do it again sooner than later. No more 6 month hiatus.
Sounds good, man.
All right. Have a good weekend.
Take care.